one of the reasons why I think we're headed toward a very sluggish economic window of time that will last the next 10, 15 years. If you look at monetary policy from the 1950s into 2000, the Fed funds rate almost always was above the rate of inflation. So it had a real rate of return.
Right. You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, hey, I can write the headlines for the story that's coming out on Friday, and that is experts surprised by sudden increase in an unexpected increase in inflation and PCE and all that good stuff. Jim Welsh is here with us now, macrotides.com. So, Jim, did I write the right headline for the story?
I think close. I mean, obviously, what I was writing about a few weeks ago was that when the CPI came out, Kerry, on April 10th, it would show a definitive increase from 3.2% up to at least 3.4 and potentially 3.5. It came in at 3.5. The core was unchanged. The PCE is probably going to be more unchanged, both the core and headline. But the point being is, given that people are now anxious to see progress on inflation because the Fed is wanting to see progress on inflation, and anything that doesn't provide that means that Fed rate cuts are pushed more out into the future. And, we've gone from 6 rate cuts at the beginning of this year to 3 before the CPI, and now it's down to about 1.5. So, again, it comes down to expectations and people wanting to see that PCE inflation, which is the Fed's most preferred thing, starts to show that it's trending down. I don't think we're going to get that. And if economists are expecting that to be the case, then they are going to be disappointed and they are going to be surprised.
All right. So this is kind of like Mark Twain, rumors of my death have been greatly exaggerated. Rumors of the upcoming Fed rate cuts have been totally exaggerated, haven't they?
They have. And it was silly all along. As I was writing back in December and January, with the unemployment rate hovering near a 50-year low and the inflation figures were well above the Fed's 2% target rate, the last thing the Fed would want to do is cut rates, adding stimulus to an economy that grew 3% last year, which would only increase the odds that in 2025, inflation would tick up. And Powell and others have said the one thing they want to avoid is the mistakes of the 1970s. And what happened in the 70s was the Fed increased rates significantly in 1969, 70. It caused a recession. They increased rates significantly in 73, 74. It led to a recession. And those recessions then forced the Fed to slash rates quickly. Inflation never really came out of the system. And by 1981, the Fed had the funds rate up at 20%. So the Fed wants to avoid that yo-yo, and which is why I think they've held the funds rate where it's been since last July. But at the same time, it's also why I think they're wanting and sensitive to the idea that cutting too soon would undermine some of the progress they've achieved. And that's why, my take was they were going to be more patient, and the data points proves that patience was warranted.
All right. So are they in control or are they losing control here, Jim?
Well, they're always behind the curve. I mean, I just think that the Fed, by its nature, is evaluating data that is in the rearview mirror. And when data points change quickly, they can't help but be, too late. And that's what obviously happened in 2021 and 2022. They were thinking that inflation wasn't going to be as bad as it turned out to be. They called it transitory, which was wrong. So it's, the problem they face in terms of understanding the difficulty of the job. The lag time between rate cuts or rate increases is variable. and it can be 12, 18 months or even longer. So again, I think that's why they're trying to be very gradual in what they've been doing, and will continue to take that course. So the one thing I will, I guess, argue strongly is the Fed has a 2% inflation goal. And if you think about it, money doubles, the cost of living doubles every 36 years at 2% and quadruples in 72 years. The average person lives, as we know, Kerry, more than 72 years, which means that in a person's lifetime, if the Fed is successful in achieving quote unquote stable prices of 2% a year, the cost of living is going to quadruple in everyone's life. And only a central banker would call that stable prices. So to me, the goal of 2% is way too high. But that's obviously not going to change. That's what they've set out. And if anything, there's potential wiggle room where they will back off that 2% target very next year, and maybe even later this year if we start seeing unemployment tick higher.
Well, Jim, imagine if the U.S. currency was like Bitcoin, and every year or two you had a halving, so they could, they had to halve the amount of money they're printing every. I think they should do it every 6 months. Can you imagine? We would have deflation, which they make it a real negative thing. But what deflation means is the purchasing power of the currency is going up. What is so bad about that?
Well, they're just worried that that only has happened during very deep recessions. They're worried that their primary tool is a funds rate. And this is a great topic to chat on here, because one of the reasons why I think we're headed toward a very sluggish economic window of time that will last the next 10, 15 years. If you look at monetary policy from the 1950s into 2000, the Fed funds rate almost always was above the rate of inflation. So it had a real rate of return. Right. Starting in 2001, the Fed dropped the funds rate to 1%. Inflation was more than 1%. And since 2001, the funds rate has been negative for that whole entire period, which implies that its effectiveness as a monetary tool in leveraging the economy, either to grow or slow down, especially grow, is being neutered. And so I think if we go into the next recession, whenever it shows up, I think next year is a very likely candidate. Is the Fed going to cut rates? Yeah. Is it going to have the same stimulative effect that it used to? I don't think so. And the other component is debt. In the 1960s, every $1 of debt generated about 90 cents of GDP. We're down to less than 40 cents for every dollar debt. And think about it, it's kind of straightforward, it's simplistically, but straightforward. Last year, GDP was up 3%. The budget deficit was 6%. So is the private economy really flourishing when most of the stimulus is coming from the federal government? And the answer to that is obviously no. So the two policy tools that they've used, fiscal and monetary policy, to kind of regulate the economy for the last 40 plus years, I think have shown to be less and less effective, which implies that the next time we go through a recession, they'll try the same thing they've always tried. I just think we're going to see diminishing results, which means less economic growth and higher unemployment as a result of that, and so forth. So, I'm glad you brought it up. The Fed policy has evolved, and I think in an unhealthy manner in the last 25 years.
All right. So let's look at the charts, Jim, and tell us what you see in the offing here.
Okay. Let's scroll down a little bit. This is a piece that you're going to have available to people who are watching this.
You just click the link.
Trends.
The link in the show notes.
Yep. All right. So, Social Security, what's happening there over the, they're both going to go bankrupt. Medicare, Social Security, what does that mean? Deficit spending.
Nothing unless you're collecting it.
Yeah, right. Last year's deficit of 6% is the biggest deficit ever during either peacetime or outside a recession. Interest expense, how it's consuming the budget and so forth. These are just charts that I think most your viewers will find informative. We'll stop here on this one. This is an important one.
Which one?
30-year treasury bond. Yeah.
Okay. Got it.
Basically, what this implies is the bull market, the secular bull market in treasury bonds that started in 1981 and lasted until 2020 has ended. And what we see is that trend line going back to 1981 was decisively broken in 2022. In addition, the decline, when you look at it, you can see 1, 2, 3, 4, 5 down until last October. I believe, Kerry, this is a signal that we've begun a new secular bear market in the bond market that's going to last 10, 20, maybe even 30 years. That's how long secular market trends last in treasuries. At least that's the case from 1945 to 81, 81 to 2020. That I think is another reason why an extended period of slower growth, because on balance, I think treasury yields are going to be higher. If we can scroll down a little bit, and we'll get to some of the other charts that are we're going to talk about. Since I don't think that you can do it.
Got it.
Go down, please. Thank you. Go down. Let's see. You can go down further. People have access to this, so they can. Let's go down a little bit more.
All right. Just tell me the heading I'm looking for.
Yeah. Okay. Here we go.
Here we are.
Yeah. The S&P long term. Yeah.
6 of 7.
Yes. So in late March, when I showed subscribers this chart, it was kind of like, all right, we've come to an interesting juncture in that from the October 22 low, you can see a rally up to July of last year, 4607, a pullback to 4100, and then the high of 5260 plus. That it was 3 waves. So if you're bullish, okay, we're going to have a wave 4 pullback of 7% to maybe 10%, and then a rally up. The bearish count is the top's in, and we're going much lower. And so to me, the two paths were like, well, we're headed south. And so I continue to think that the decline that we saw initially really getting kicked off in response to that CPI report, Kerry, I think has more to go. We got really oversold. We got a bounce. I think the S&P has a chance to get down towards 4850 or so. That's the 382 retracement. Treasury yields, the rally from last October to the high in TLT at 100. I think, as I said just a minute ago, 5 waves down in Treasury bonds and in TLT suggested we were going to have a counter trend rally. I turned positive in October, looking for a big rally. We got it from 82.50 to over 100 in TLT. In late December, my expectation was we would see yields go up because the idea of 6 rate cuts was ridiculous, and that TLT would retrace a big portion of that decline. The 618 retracement is at 86.30 on TLT. So my take here, Kerry, is I think it's getting close to the time to buy TLT. The GDP report for the first quarter comes out tomorrow. It's going to be north of 2%. As we discussed, the PCE is not, I think, going to offer much inflation comfort. So I think we could see TLT dip there. I guess the overall view I have is we're going to see the economy slow more than what people expect. In 2022, the majority of economists were talking about a recession. Now, 65% of them don't think a recession's coming. The yield curve, the historical lead time on that is 19 months. Well, 19 months from July of 22 is January, February of this year. So we're just at that point in time, Kerry, that historically, going back to the 1950s, the yield curve has signaled a recession. So my take is that we're going to see the economy as we get to mid-year and beyond slow more than expected. That sets TLT up for a rally that I think could carry it up to 105 to 109. And in terms of the dollar, my take at the end of December was, like I said, the idea of 6 rate cuts was ridiculous. We were going to see Treasury yield move up, and that would lend the dollar a tailwind. It would rally it to 104, and then most recently refined it to the 106.50, 106.70. I think once this upcoming rally is over, and again, the final touch could come in the next couple of days with the GDP and PCE reports, that the dollar will top. And then I think ultimately sometime in this year, Kerry, will see the dollar trade below 100. And that, I think, will be, again, in response to a weaker economy. In terms of gold, in February, I recommended buying gold. And the expectation was we were going to be trading. And really, the last time we talked was, hey, I'm bullish gold. It's going to rally above 2,300 this year. It obviously did better than that. I think we're at a point, Kerry, where a pullback in gold to the 2250 and maybe a touch below will evolve. It'll take weeks, not days. Sentiment got a little frothy. After that pullback, I think we're going to see higher highs in gold. Again, if the Fed is forced to cut rates, not because inflation's down, but because the economy's weakening, I think that's a real tailwind for gold, because I think it'd be negative for the dollar. So that's a brief outline of the markets.
Interesting times ahead, that's for sure. And even silver has joined in on the fun. I think we got your take on it. So, Jim, appreciate you coming on. You find Jim's work over at macrotides.com. Beware of the dollar, beware of gold, beware of T-bills and treasuries, that's for sure. And hey, got any questions for Jim, myself, email kl@kerrylutz.com. The link to Jim's site is in the show notes of this interview on financialsurvivalnetwork.com. Make sure you go there, sign up for your free newsletter. Jim, appreciate you stopping by. We'll talk to you again real soon.
Thanks to be talking with you, Kerry, and stay well.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.